Several of you have been asking in the comments whether the gold rally is over, whether the correction from January's highs means the big move has already happened, whether the people saying sell now are actually reading the situation correctly. Today, we are going to answer that with the actual data, not opinion, not price targets pulled from thin air, the documented, verifiable, institutional-grade data that tells you exactly what is driving this market and exactly where it is heading. This is Go Finance. Let me start with where gold actually stands right now, because the numbers matter more than the narrative. Gold hit an all-time high of $505 per ounce in January 2026. That was the best start to a year for gold since 1980. A year that most people reading history books describe as one of the most financially turbulent periods in modern American history. Since January, gold has corrected to approximately $4,600 as of early May 2026. That is a 15% pullback from the peak. On a chart, it looks concerning. In the context of the data underneath it, it tells a completely different story. In Q1 2026, the World Gold Council reported that total gold demand, including over-the-counter transactions, was up 2% year-over-year at 1,231 tons. The quarterly average gold price hit a record $4,173 per ounce. Bar and coin demand of 474 tons was the second highest single quarter ever recorded in history. Central banks bought 244 tons in Q1 alone, up 3% year-over-year, and the total value of quarterly gold demand hit a record $193 billion. Not tons, dollars. $193 billion in physical and investment gold demand in a single quarter. Let that number land for a moment. Even during a correction, even after a 15% pullback from the highs, even with oil above $100 and the Fed frozen and the paper market selling pressure from leveraged traders flushing positions, the physical demand for gold hit record dollar values. That is not a market that is dying. That is a market that is repricing. Those are two completely different things, and confusing them is one of the most expensive mistakes an investor can make. Now here is the question that matters most right now. Why is this happening? Not why did it happen last year? Why is it happening right now in May 2026, when the price is in the middle of a correction and the headlines are full of uncertainty? The answer has 5 separate structural drivers that are all operating simultaneously. Each one individually would be enough to provide a floor under gold prices. All 5 together explain why every major investment bank in the world, JP Morgan, Goldman Sachs, Deutsche Bank, Wells Fargo, UBS, Morgan Stanley, BNP Paribas, Societe Generale, is projecting gold significantly higher from current levels by the end of 2026. Let me walk through each one carefully because understanding them is the foundation of everything else in this video. Driver 1. Central banks are buying gold at a pace that has no precedent in modern history, and they are not stopping. Before 2022, central banks around the world bought approximately 200 tons of gold per year on average. That was the normal baseline. That was the expected, predictable, unremarkable pace that had defined central bank gold behavior for decades. From 2022 through 2025, central bank purchases averaged approximately 1,000 tons per year, 5 times the historical average. And nothing in the current data suggests they are stopping. The People's Bank of China reached an all-time high of approximately 2,309 tons of official gold reserves in Q1 2026. Goldman Sachs estimates central bank purchases are now averaging around 60 tons per month, 720 tons annualized. The World Gold Council found that 95% of central banks surveyed, the highest share ever recorded in the history of that survey, expect their gold reserves to grow within the next 12 months. 95%. That is essentially unanimous agreement among the institutions that manage the world's monetary system that gold reserves need to increase. Now ask yourself the obvious question. Why are the institutions that manage the world's currencies suddenly buying the one asset that those currencies are supposed to replace at 5 times their historical pace? The answer is traceable to a single specific date, February 2022. When the United States and its allies froze $300 billion in Russian central bank foreign exchange reserves, every government watching concluded the same thing. Dollar-denominated assets can be sanctioned, frozen, or seized by executive order. Gold sitting in a domestic vault cannot. That was not a temporary reaction to a temporary crisis. It became permanent policy, and it is compounding with every year that the geopolitical fracturing of the global order continues. JP Morgan's quantitative framework holds that every 100 tons of committed central bank buying corresponds to approximately a 1.7% increase in the gold price. JP Morgan models central bank buying of approximately 800 tons in 2026. That structural demand alone provides a floor for gold prices that is independent of everything else, independent of ETF flows, independent of retail buying, independent of the Iran war, independent of the Fed. The central bank floor is structural, it is documented, and it is not going anywhere. Driver 2. The United States has lost its perfect credit rating, and the math behind that downgrade is accelerating. In May 2025, Moody's downgraded the United States government's long-term sovereign credit rating from AAEA to AA1. This made Moody's the third major rating agency to downgrade U.S. credit, following Standard & Poor's in 2011 and Fitch in 2023. The United States no longer has a perfect credit rating from any of the 3 major agencies, not one. Moody's cited what it called significantly higher debt and interest payment ratios compared to similarly rated countries. The numbers behind that assessment are extraordinary. The U.S. federal deficit is currently running at approximately 6 to 7% of GDP at full employment, not during a recession, not during a war, at full employment. Federal interest expense is approaching $1 trillion annually, now the largest single line item in the federal budget, larger than defense, larger than Medicare, larger than Social Security. Moody's projects that U.S. deficits will reach nearly 9% of GDP by 2035, and that the national debt will reach 134% of GDP by that same date. Interest payments on U.S. federal debt are on track to consume 30% of all government revenues by 2035. Let me put those numbers in historical context, because context is everything here. The United States has never exceeded 120% debt to GDP, even at the height of World War II, when the country was mobilizing the largest military force in human history and fighting on 2 separate global fronts simultaneously. The projection is 134% by 2035, with no comparable mobilization to show for it. Ray Dalio, founder of the world's largest hedge fund, Bridgewater Associates, has described the skyrocketing national debt as, quote, a heart attack threatening the economy. Warren Buffett said at the 2026 Berkshire Hathaway annual meeting that markets are like a church with a casino attached, and that we have never had people in a more gambling mood than right now, when 2 of the most successful capital allocators in the history of American finance are using language like heart attack and gambling to describe the current environment that is not hyperbole designed to generate headlines. That is experienced judgment delivered to the people who manage the most capital in the world. From 1971, when the U.S. abandoned dollar-gold convertibility under President Nixon, through 2025, gold rose from the $35 per ounce to over $5,000, while the dollar lost approximately 87% of its purchasing power, according to Bureau of Labor Statistics (CPI) data. The dollar did not stay stable while gold went up. Gold stayed stable while the dollar went down. That relationship has not changed. The only thing that has changed is the pace at which the dollar's purchasing power is being eroded. Driver 3. De-dollarization is accelerating, and the mechanism that drives it cannot be reversed. The global shift away from dollar-denominated reserves is not a theory or a prediction. It is documented, measurable, ongoing, and structurally driven by a force that cannot be undone. China's treasury holdings have declined to their lowest level in more than 15 years. Japan has been selling treasury positions to defend the yen and manage domestic bond market pressure. Multiple emerging market central banks across Asia, the Middle East, and Latin America are actively reducing dollar exposure. The dollar index has been trending lower under the combined weight of fiscal deterioration and geopolitical distrust. The financial architecture of the post-World War II era was built on a simple, implicit contract. The United States would manage the world's reserve currency responsibly, transparently, and in a way that served the global economic order. In exchange, countries around the world would hold their reserves in dollars and accept dollar-denominated trade settlement as the global standard. That implicit contract has now been broken in multiple visible and documented ways. The freezing of Russian assets demonstrated that dollar reserves can be weaponized through executive action with no judicial review and no recourse for the asset holder. The Moody's downgrade demonstrated that the fiscal management of the reserve currency issuer has deteriorated to a level that no longer warrants a perfect credit rating. The Iran war has demonstrated that U.S. security guarantees have loopholes, that the most powerful military in history can quietly evacuate its most valuable assets before a strike occurs and leave the host nation to defend itself. And the political dysfunction in Washington has demonstrated that the management of the world's reserve currency is not immune to domestic political pressure, unpredictable policy shifts, or the short-term incentives of electoral politics. Every country watching this sequence of events is drawing the same conclusion independently. A diversified reserve portfolio that depends too heavily on dollar-denominated assets is a portfolio that can be compromised by decisions made in Washington that you have no influence over. The natural response is to diversify into assets that no government can sanction, freeze, or seize. Gold is the only asset that meets that definition at institutional scale. Driver 4. The Federal Reserve is trapped in a policy dilemma that gold has historically exploited to the upside. Here is the precise situation. As of May 2026, gold is at approximately $4,600. The Fed funds rate is at 3.5% to 3.75%. Core PCE inflation is running above the 2% target. CPI came in at 3.3% year over year in March 2026, the highest reading since May 2024, with a 0.9% monthly jump that surprised markets. The Strait of Hormuz remains partially blocked from the Iran conflict. Oil is above $100 per barrel. The CME FedWatch tool shows a 5.1% probability of a rate cut at the June meeting. 94.9% of market participants expect rates to remain unchanged. And Goldman Sachs, which had previously projected 3 rate cuts in 2026, has pushed its first cut forecast back to September. The Fed cannot cut rates because inflation is too high, and the energy shock from the Iran war keeps refilling the inflationary pipeline every week. It cannot raise rates significantly because the debt service cost on $39 trillion in national debt would become crushing at higher rates. Every quarter-point increase in rates adds approximately $100 billion in annual interest expense to a government already spending $1 trillion per year on interest. It cannot stay on hold indefinitely without eroding the credibility that is the foundation of monetary policy. Every single option available to Jerome Powell comes with a painful trade-off that the Fed has never faced in quite this combination before. That is what trapped means when analysts use that word, not powerless, trapped. Now here is the critical relationship most people do not understand about what happens when the Fed eventually moves. Goldman Sachs has modeled that each 25 basis point Fed rate cut generates approximately 60 tons of new ETF gold demand within 6 months of the cut. Global gold ETF assets under management doubled to an all-time high of $559 billion in 2025, with physical holdings reaching a historic peak of 4,025 tons. Those ETF holders are positioned and waiting. They have the capital, they have the conviction. The only thing they are waiting for is the policy signal that changes the opportunity cost calculation of holding non-yielding gold. When the Fed eventually cuts, and the weakening growth data is already forcing that conversation, a wave of new institutional ETF demand will arrive on top of the central bank structural floor that is already supporting prices at current levels. The historical precedent from the 2019 rate cycle is directly applicable here. When the Fed cut rates in July 2019 for the first time in over a decade, gold rallied approximately 7% in the 6 weeks that followed. The 2026 structural backdrop, central bank buying at 5 times its pre-2022 pace, and ETF holdings positioned for re-entry after months of rate-driven headwinds, suggests the price response to the first cut this cycle will be meaningfully larger than what we saw in 2019. Driver 5. The Iran war has created a structural energy shock that keeps the inflationary clock running and the stagflation thesis alive. This is the driver that gets the least attention in gold market analysis, and it may be the most important for the next 12 to 18 months. When the United States and Israel struck Iran on February 28, 2026, the Strait of Hormuz was restricted. Oil surged past $100 per barrel. BLS March 2026, CPI data showed 3.3% year-over-year inflation with a 0.9% monthly jump, numbers that made it essentially impossible for the Fed to signal any near-term easing. Qatar Energy flagged the possibility of force majeure on long-term LNG contracts for up to 5 years, covering supplies to Italy, Belgium, Korea, and China. European spot gas prices jumped 18% in a single day when missile alerts forced a partial shutdown at Ras Laffan. American gas prices jumped 90 cents per gallon in just 19 days, one of the fastest retail fuel price spikes on record. Here is the mechanism that connects all of this to gold in a way that most analysis misses. The energy shock keeps inflation elevated. Elevated inflation keeps the Fed frozen. Fed frozen means rate cuts get pushed further out. Rate cuts pushed further out means the short-term opportunity cost headwind for gold persists. But here is the critical second-order effect. That same energy shock is simultaneously preventing the economic growth that would normally justify tight monetary policy. GDP growth was already fragile before the war. Consumer spending is under pressure from gas prices that jumped nearly $1 in 3 weeks. Oxford Economics cut its 2026 U.S. growth forecast from 2.5% to 1.9%, specifically because of the war's effect on consumer spending power. Bank of America data showed that gas spending on its credit and debit cards shot 14.4% higher year over year in the week ending March 14th. What you get in that scenario is not high growth with high inflation that justifies tight policy. What you get is low growth with high inflation simultaneously. Stagflation. The word that economists use with great reluctance because of the particular kind of policy paralysis it creates. The Fed cannot tighten its way out without crushing an already weak economy. It cannot ease its way out without igniting inflation further. The only assets that historically preserve purchasing power in genuine stagflation environments are real assets that cannot be inflated away. That list is short. Gold is at the top of it, and the Iran war is creating precisely those conditions. Now let me give you the institutional forecasts because the scale of professional consensus here is remarkable. JP Morgan projects gold to average $5,055 per ounce by Q4 2026 and $5,400 by end of 2027. Goldman Sachs lifted its December 2026 forecast to $5,400, stating that hedges against global macro and policy risks have become sticky, effectively lifting the starting point for gold prices this year. Wells Fargo raised its year-end 2026 gold target to $6,100 to $6,300 and explicitly advised clients to buy the current dip. Deutsche Bank is projecting $6,000 by end of 2026. BNP Paribas forecasts $6,000. Societe Generale projects $6,000 and calls it a potentially conservative estimate given the structural drivers. Morgan Stanley has a bull case target of $5,700. UBS targets $5,900 by late 2026 after a short-term dip. ANZ raised its Q2 2026 forecast to $5,800, and in an extreme scenario where ETF and central bank demand continue at current rates, Scottsdale Bullion analysts model $6,150 by Q4 2026. Not one of these institutions is calling for gold to fall from current levels on a 12-month horizon. Not one. The range is from $5,055 at the conservative end to $6,350 at the aggressive end, with multiple major banks clustered around $6,000. The question is not whether gold goes higher. The question is how much higher and how quickly. Now let me give you the honest counter-argument, because intellectual honesty is what separates serious analysis from cheerleading. Gold underperformed meaningfully from 2012 to 2018, 6 consecutive years where the structural debasement thesis was perfectly valid, and gold still went essentially nowhere. An investor who entered at the 2011 peak, $1,900 per ounce, did not see a full recovery to that level until 2020. 9 years of holding through a thesis that was analytically correct but temporally frustrating. The lesson from that period is not that the thesis was wrong. The lesson is that conviction in the long-term case does not eliminate the possibility of multi-year drawdowns. Position sizing and time horizon matter as much as analytical correctness. The current bear case for gold requires believing several things simultaneously: that oil prices normalize quickly as the Iran conflict resolves, that inflation falls back toward the Fed's 2% target within the next 6 to 12 months, that the Fed resumes a credible tightening path, and that the structural de-dollarization trend reverses as global trust in dollar-denominated assets recovers. None of those outcomes is impossible, but each one requires a positive resolution that current data does not support, and that the institutional forecasters cited above are not projecting. Most importantly, the bear case requires central banks to reverse the most consistent and well-documented multi-year behavioral shift in their reserve management in modern history. From 2022 through 2025, central banks bought approximately 1,000 tons per year of gold. That is not a temporary reaction to a quarterly news cycle. That is a permanent structural reassessment of what a safe reserve asset looks like in a world of weaponized dollar reserves, rising U.S. deficits, and accelerating geopolitical fragmentation. The institutions managing the currencies of the world have decided that gold is a strategic necessity at the highest levels of sovereign financial planning. That decision does not reverse because oil drops for a quarter or because a ceasefire holds for a month. What this means practically for stackers right now, the correction from $5,405 to $4,600 is a 15% pullback in a bull market that ran from approximately $1,800 to $5,405, a 200% move over approximately 3 years. A 15% correction in a 200% bull market is not a crisis. It is a normal, healthy, expected consolidation that shakes out the leveraged paper traders and the momentum chasers who bought for the wrong reasons. It is exactly the kind of move that historically provides the next entry point for the people who are buying for the right reasons. The Q1 2026 World Gold Council data is the clearest signal available. Bar and coin demand of 474 tons, the second highest quarter ever recorded. Total quarterly demand value of $193 billion, a new record. Central bank purchases of 244 tons, up 3% year over year, even at all-time high prices. Serious money is not selling, serious money is accumulating. The investors writing the biggest checks, the institutions with the longest time horizons, the sovereign wealth managers thinking in decades rather than quarters. They are using this correction to add to positions, not to exit them. We are stackers here. We understand the difference between short-term paper market signals and long-term structural forces. We understand that the price on a screen on any given Tuesday in May is not the same as the value of a real asset backed by 5,000 years of monetary history and supported by every structural force in the current global economic environment. We understand that the most dangerous thing you can do in a real bull market is let a temporary correction shake you out of a position that the data says is fundamentally correct. The 5 drivers are all still intact. Every single one of them has gotten stronger since January, not weaker. The correction did not change the thesis. It gave you a better price to continue executing on it. Watch the Fed's language around rate cuts. Watch central bank gold buying data for Q2 2026. Watch whether Qatar Energy formally declares force majeure on LNG contracts. Watch European energy prices. Watch the dollar index. And watch the physical market premiums, because the physical market has been telling a completely different story than the paper price throughout this entire correction. The paper market responds to the rate signal. The physical market responds to the structural reality, and in every previous cycle, the physical market has eventually been proven right. Drop a comment below. Where are you watching from, and what is your gold price target for end of 2026? I read every comment, and I will pin the best analysis. If you want this analysis in your inbox every morning before markets open, join the Go Finance newsletter. Every day before the session starts, you get a direct summary of what is moving gold and silver, what the data says, and what to watch. No noise, no headlines, just the information that matters before anyone else has it. Link is in the description and in the first comment below. Subscribe, turn on notifications, data before price, the Vault Keeper.